William O'Neill, founder of newspaper Investor Business Daily, once wrote that you can start investing with as little as $500 to $1,000. While this is encouraging for investors looking to start off, many don't fully understand the products and services available to them. Sure, we can pick our own securities and investments, but that can be a daunting task. So what can we do if we're looking to outsource the investment management process? We'll answer this question and more on today's Plain Bagel. So let's go over what we've covered so far. When we invest, we are typically buying a security that will either grow in value, meaning that you can sell it for more than what you purchased it for, or pay you an income of sorts on a periodic basis, both of which help you grow your wealth and meet your financial objectives. These securities can be categorized as either traditional investments or alternative investments. Your traditional investments include cash equivalents, bonds, and stocks, while your alternative investments pretty much includes everything else, though we specifically covered real estate, commodities, and derivative investments. These securities are sold by different companies and investors, and depending on which one you buy and from which issuer, you'll face unique risk-return trade-offs. To manage our risk, we can diversify by holding different securities from different companies in different countries and sectors to avoid being overweight to any specific position. Great. So how do we pick our investments? Well, one option is to do it ourselves, analyzing the companies that we are interested in and taking care of the administration of our holdings. I say administration because investing doesn't end once you've picked and purchased your securities. Oh no, my friend. Investors need to frequently monitor their holdings, and some need to rebalance their holdings to ensure that their portfolio remains properly diversified when values change. Rebalancing simply means reallocating money from your overweight positions to your underweight positions. And it works like this. Let's say that you buy 3 investments for $1,000 each. On day 1, you'll have an equal weight in each investment. But as time passes, the holdings will perform differently. So let's say a year passes, and your holdings are now worth $1,800, $1,200, and $900 respectively. The percentage weight of each has now changed, and the first holding is now worth the most, meaning that we are no longer equally diversified among the investments. The issue with this is that we are now more heavily exposed to position 1, so any risks specific to that holding are now amplified. So to bring our holdings back to an equal level, we can simply sell off a bit of the first position and use the proceeds to buy some of the other 2 until the 3 are worth the same amounts again. Now, the cool thing is that by rebalancing, we've implicitly followed the age-old advice of buy low, sell high. Think about it. When the price of an investment increases, it causes the holding to become overweight in our portfolio. So when we rebalance, we sell the higher valued positions, aka sell high. And when a position becomes underweight, or when the price of the investment falls, we buy low. Now, it's important to note that not all investors subscribe to rebalancing. Some believe that if a stock does well, you should let it run. But most investment professionals will implement rebalancing to some degree, whether it be on an annual basis or whenever a position falls a certain degree outside of its weight. Regardless, combining this with the need to research and pick our holdings sets us up for a bit of a commitment. So, if we don't want to do the work ourselves, what's option 2? Well, we can use something that's called a managed solution, which will do the work for us. Managed solutions encompass anything that involves paying a fee to have a professional or a team of professionals pick your investments and manage them for you. There are a number of these available to investors, but today we'll highlight 3: discretionary management, mutual funds, and hedge funds. Discretionary management is probably the most straightforward of the 3 since it involves hiring a professional to make your investment choices for you. This professional, which is known as a portfolio manager, takes your investment objectives, constraints, preferences, and so on, uses this information to pick individual securities that they deem appropriate for you, and then takes care of the rest on your behalf. A discretionary manager will typically be independent, which means that they are not incentivized to pick certain investments over others when making decisions for you. Sounds like a pretty sweet deal, but there is a catch. These services often require that you bring to the table a minimum investment that can range anywhere from $100,000 to $1 million. Why the barrier? Well, the reason has somewhat to do with trying to diversify with small amounts of money. Let's say, for example, that your portfolio manager wants to invest your money equally into 30 different securities to ensure that you are properly diversified. Each security comes at a different cost, ranging from $10 a unit to $1,000. If you wanted the same amount of money invested in all 30 positions, you need to have at least $30,000 invested, or $1,000 per position, since the minimum investment per position has to match the highest investment price. If you bring any less to invest, the PM won't be able to properly diversify, and therefore will be unable to fully employ their strategy. And so some PMs set this minimum investment amount to ensure that their service is worth the fee. But if you're starting off with $5,000 to invest, then you're out of luck. So what are you to do? Well, here's a crazy idea. What if you found 5 friends who were also looking to invest $5,000 each, and you combined your money? With your combined $30,000, you could hire a professional to invest and manage the amount, and split the costs and returns equally. Well, you can't legally combine your money on your own, but you can accomplish this crazy idea through something called a fund. There are many types of funds out there, but mutual funds are one of the most popular. With mutual funds, an investment firm will collect money from different clients and distribute units to the investors, representing how much of the fund belongs to them. Then the firm will invest the money under one portfolio and split the return and the cost among unit holders. When the portfolio grows in value, so too will your units that you were given. So your units essentially mimic the return of the larger diversified portfolio. Naturally, the fund won't be custom tailored to any one investor, but the size of the fund will allow it to fully implement its strategy and maybe even save some costs. A bonus to this is that mutual fund units are often sold pretty cheap. You can easily pick one up for $10 a unit, meaning that you can start investing with virtually any amount of money. Mutual funds are also sold through representatives who can act as a point of contact for your investment questions, though these representatives won't offer the same independence offered by discretionary managers. Now, mutual funds are the only funds available to investors. There are many others out there, such as segregated funds, which are sold by insurance companies and offer bonuses such as minimum value guarantees, though these features come at a pretty hefty fee. There's also pooled funds, which are catered to more higher net worth clients, but probably the most interesting fund out there is the hedge fund. Hedge funds are similar to mutual funds. However, only high net worth investors with millions of dollars can typically invest in them. Why? Well, the reason has to do with the types of investments and strategies these funds utilize. For example, some hedge funds focus on investing in bankrupt companies that they believe will make a full recovery. Because these strategies can lead to significant losses, hedge funds typically require that its investors be accredited, which quite frankly just means that you need to make a lot of money to buy its units. The thought is basically that accredited investors can afford to lose their investment in hedge funds if things go sour, whereas everyday investors likely won't be able to swallow the risk. By catering to accredited investors, hedge funds are able to invest in things like derivatives and new strategies that mutual funds aren't allowed to. Additionally, catering to accredited investors allows the fund to avoid regulation, meaning that they don't have to report their information. There are claims that hedge funds earn much higher returns than conventional funds because of all these extra privileges. But it's hard to know for sure given this added secrecy, and the fact that we only see the information they want us to see. Pretty interesting, isn't it? But kind of disheartening for everyday investors who don't have access to these cool vehicles. But don't fret, the industry continues to evolve every day, with things such as ETFs and robo-advisors continually expanding the capabilities of everyday investors. But that's a topic for another video. For now, we're out of time. If you like this video, please hit the like button, and if you like what we're doing, please subscribe. If you have any feedback or topics you'd like us to cover in future videos, please leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today.